Okay, here we are, back for another monthly No Bondcast live. I'm Matt Morizio. I'm an advisor here with Beck Bode, and here with none other than the CIO himself, the Beck of Beck Bode, Benjamin Beck, aka Big Ben. Only called that by one person and one person only, but I will not let it go.
Hey kids, Big Ben comment. I love it. I love it.
And here we are for part 2 of our growth strategy explanation. Which
so incredible. We had to break it into 2 parts.
That's right. It's that good. No, I'm excited that we're coming back to talk more about it, because honestly, what we're doing, we're voluntarily peeling back the layers to say, this is how we do it. This is what we do. And I think that's exactly the problem, if you ask me, in our industry. And I want to hear from your experience, but for me, the biggest problem is the lack of transparency or uncertainty, or just lack of clarity on what the heck's happening with people's money. So I want to hear your thoughts on that. Have you experienced that too?
Yeah, I think anything, if forget about the markets for a second or investing, anything that we are not familiar with, right? That's not part of our everyday, right?
Yep.
Whether, you're going away to college for the first time and you're not familiar with the area that you're in, or let's talk about you're not familiar with the stock market. And then it comes down to, okay, well, where do you get the information about the markets and everything? That's part of your learning process. And a lot of that comes from the media, right? A lot of that comes from what you hear on TV and in the newspapers and such. And information is not always true, right? Or it's not always the whole story. So I think you're right, Matt. I think, well, certainly my experience has been that, look, the stock market, the economy itself, what determines how well or how poorly you do happens in the future, and quality information you have, and so on and so forth. And there's just a lot of misinformation out there about it. People are unfamiliar with how things really work behind the scenes. And I think, by demystifying the process like we're going to do today, I think that's a huge step in the right direction.
Absolutely. I think I'll go as far as to say, in thousands of conversations at this point, the single biggest problem, in my opinion, with people and their investments is that they will spend, and I've said it before, they will spend so much more time reading reviews on a $30 Amazon purchase, making sure it's 4.5+ stars and all positive reviews, and then they'll go and buy that. But then I'll ask in the next breath, okay, and how did you go about selecting your investments, or your advisor to select your investments? And it's like a deer in the headlights.
Yeah.
I don't know. I don't know what's happening with my money, And that's, to me, the way to break down that barrier is what we're trying to do today. It's through education, because what you're talking about, when you expose yourself to something new, it's scary until you learn about it. And then you learn about it, you're like, all right, this isn't as bad as I thought. Like, I understand the campus now.
Yeah.
Or I understand what this gym is like, or I understand what high school's like now that I'm a freshman. I'm not so scared anymore. But stepping into that unknown was scary until education happened. So I think education is like the single biggest barrier breaker that we can actually provide for people. Whether or not you agree with our philosophy or our strategy is fine, because at least you understand our philosophy and our strategy, right? Yeah. It's easy to agree with something or disagree with something that you at least can comprehend. The problem with the industry is there's so much incomprehensible stuff out there that people say, I trust you, just do it, whatever. But I think that power needs to be shifted back into the investors and say, do I want to have my money managed this way? And if so, move forward with excitement. If not, don't move forward with confidence, knowing I'm not picking this for these reasons. Does that make sense? Do you have that same experience?
Yeah, I think so. And I think some of the things that you're hitting on, one in particular that stands out to me, we talk about it a lot. We talked about it last week or the week before when we had the first part of this, is that a big part of this educational process, like you said, is understanding the process of what's going to happen when I give somebody my money.
Yep.
And what should my expectations be on that process going forward? And we talked last week about how we see things, and that one of the things that we mentioned was many times is having the answer to those three critical questions, right? In my experience, I know in your experience, Matt, because you went through that. We was recently talking to a new client of ours today, or just became a new client, who actually, in a really funny way, went out and tested what we were talking about in terms of go out there and ask other financial professionals. Don't sign the paperwork to become a Beck Bode client yet. Go out there and test what we're talking about in terms of ask other financial professionals what the process is to buy, what their process to buy. Then ask, when are you going to sell what you bought? And then when you do sell, where do you reinvest the proceeds? See what kind of answers you get, if you get answers at all. And that's what we're all about, right, Matt? I mean, that's we want to appeal. Our whole thing is to appeal to something that's very reasonable and realistic to understand, knowing that tomorrow is unknown. But what you want to do today is be educated, learn as much as you can, and be able to make an educated decision about, do I think this particular investment firm or this particular financial advisor can deliver what I need to whatever your long-term objective is: retire, put your kids through school, leave a legacy, pay for your grandchildren's education, whatever that objective may be. So yeah, that has been my experience, is that this educational process is so incredibly important. But the flip side to that is there's just so much out there that is just bombarding, individual investors that you and I talk to every day. It can be really hard and overwhelming. And so I think this is a great idea you came up with actually today, in more of an unscripted format. Say, hey, look, let's peel back the onion, as we've done at least a number of times in the past, and actually talk specifically, share a screen and talk about how we go about doing this.
Yes, I can't wait. Before we get right under the hood, I'm going to refresh anybody listening that maybe didn't see part one of this, how we see the investment world. So we believe money's made in the future, which is the scary part, because we don't know what the future has in store. So we have to work with the unknown. It's easy to be a rear view investor and say, man, if I only invested in Apple 30 years ago, those are simple decisions, but you can't make money that way. So you have to make money in the future. We rely solely on top analysts, research, information on Wall Street, who are paid sometimes millions of dollars to produce this research to effectively predict the future of companies. Like the weathermen of Wall Street, they're either saying the future looks bright for these companies or not. And it's our belief that we want to hold on to companies who have continually brighter futures. And the opposite is true too. We want to let go and cut ties with any company whose future no longer looks as bright as it once did. Because historically speaking, those companies who have brighter and brighter and brighter futures consistently outperform expectations, and their share price rises accordingly. So we want to catch on to those types of companies. Fundamentally, that's it. That's our belief, and there's more to it. But the cool part is we're going to show you exactly how we do that today. So I want to share Ben, you can share your screen and explain exactly what it is we're looking at, because this is our process. We don't have a process that we say we have and then don't follow. We actually have a process, and I want to show people, hey, this is how we categorize our buy companies, and this is how we look at the world, and this is where we pull information every single day. And we're not lying when we say every single day. And when the information says that the future no longer looks so good, you're going to see that too. Yep. So explain what we're looking at, Ben. Could you zoom in like a million% so that I can see it?
Well, this is, I did this on purpose to start, right? Because I want, without going too far out, I just want to give folks that aren't familiar with our strategy an idea of the depth and the breadth of the information that we're looking at here. So on any given day, first of all, our company, our investment committee, is tracking in the upwards of 3,000 to 4,000 publicly traded companies every day. And we're pulling in information about these companies in real time. And what I mean by that is the top flight analysts on Wall Street that we focus on. Information is power. So to spend a moment on that, as Matt, you started to allude to a second ago, is that we spend a lot of money on organizing and analyzing, obtaining data from the top analysts on Wall Street, because we are firm believers, and this is just not something that we came up with a minute ago, but we have empirical proof that the better the information that you have at your fingertips, the more quality information that you have, the better your overall returns will be. Now, there's something else in there that is pertains to not only having some of the best information, but actually having the ability and the expertise to use that properly, which is really important. And that's what we're going to talk about today. As Matt alluded to, we want to own a company today in a portfolio. So think about your investment portfolio. We want to own a company where in the future, right, as Matt said, in the unknown, that company is going to get stronger and stronger. And we quantify stronger and stronger as what we refer to, and the industry refers to, as earnings estimates. These top flight analysts that we're using are all the time, these analysts are responsible for a particular sector, generally, of the economy, technology or healthcare or financial companies. And so they're specialists. They are the weathermen, as Matt said, and experts in a particular industry. And big part of their job is to estimate what a particular company within their realm is going to earn in terms of profits over the next 12 months. They actually report it quarterly and typically annually as well. We follow the annual estimate. And so what we're looking for to narrow down, right? We're not going to own 3,000 or 4,000 companies, which I'll touch on in a second here. But we want to own in our growth strategy about 15. So how do we go about selecting that 15? The first thing we have to do is cull down the universe, right? Not all these companies that are on this particular list are eligible to buy. So how do they become eligible to buy? Is that we need to see a pattern of exactly what Matt said before. Good companies getting better. And
Ben,
so,
can I pause you real quick? Just want to highlight something that you're saying is everything we're talking about is owning individual stocks, individual companies, which almost has become taboo in the industry. We're not saying go buy a bunch of funds and ride waves. So we are actually buying companies. I just want to make that point super clear that probably is not talked about with almost any other advisor.
Right. Yeah, it's definitely something that is not very heavily practiced nowadays in the broader investment world, right? Like you said, a lot of our industry, if you go to a financial advisor, another firm, you're placed in a product, which is a fund, like you said, or an ETF is an acronym you hear a lot about, which is oftentimes a large collection of individual stocks, which I'll get into in a second. Okay. So what we're looking for to narrow the universe down is we want to see a pattern of the prospects of this company as it applies to their earnings in the future getting better. And so the analyst, as you see here, now I highlighted a company here, which I'm gonna zoom in on. Now this information is actually from months ago in the past to make some illustrations here, but here you have along the left-hand side, you have the ticker symbol for the company, you have the name of the company, you have the sector that it's in, market cap in terms of stated in billions of dollars. So Nutrien is a $34 billion company in terms of market capitalization. Their price at the time, market price at the time that this report was generated, dividend yield. But here is where a lot of the magic is. It's as we start moving from this column here, going over to the right.
Could you zoom more? Are you able to zoom any more?
Yeah, let's do it.
Awesome.
Get in there.
Yeah.
All right.
Hold it up to the magnifying glass level. There we go. Now
There
we're
we
starting
go.
using words.
Cool. All right. So here's what we're looking at. We're looking at how many consecutive revisions. Now, all these things to the right here, you see in red and green and such. I'm going to go back to Facebook here because that's the one I highlighted before. So if you look to the right here, you're seeing the dates and what our team is doing. One of the things that our team is doing, it's pulling in data from our research sources. And these numbers here, 871, 871, 871. Whoops. All of a sudden, you see a 905. That means the analyst on that day had come back and said, previously, I thought Facebook was going to earn $8.71 per share in profits. Based upon new information, whatever that information was at the time, we now are raising our future expectation for Facebook to 905. And then, let me see how far in the future here, if I can find one here. Oh, here we go. So that was probably the equivalent of maybe 3 weeks later. Again here, and you see 905, and then all of a sudden you see 910. So within a relatively short amount of time, you're seeing the analyst raise the estimate upward one more time. And when we can, or when we think of what we're actually looking for, we're looking to grab all that opportunity that's out there in the future. And we need a metric, we need a criteria to follow to be able to narrow our universe down to companies that, hey, these companies are great companies. And within a short amount of time, the analyst has been raising his or her estimates upward. In other words, those prospects are getting better. And that's exactly what we want to see on the buy side, is that we want to see companies that are great companies getting better. We also, which means the analyst is having trouble estimating the earnings for the company. We want to see the analysts struggling a little bit in terms of properly predicting what the company is actually going to earn. That makes sense how I described it so far, Matt?
Yep, that's perfect. And will you, you might get into it actually. I think it's important to note for people that the dates at the top are the daily estimates. They don't always change, they're same. But when we say we track everything we own daily, it's proof there that every single day, trading day of the year, we're pulling that information in. And then the greens are shaded as, you can probably explain that in a bit, probably why the different shades of green.
Right. So basically what the green represents is the green represents anytime the analyst has, compared to the last estimate, revised it higher. But we also see in marked in red means that the analyst, compared to the last estimate, has lowered the estimate, which is actually a good segue into explaining what you and I, Matt, and our clients know as the most important part of this process. And I would argue the most important part of any investment process. And no question why it was featured as one of the 3 questions. The most important question, not what to buy. Even though what to buy is somewhat important, it pales in comparison to understanding when to sell. When to sell is so vitally important when it comes to the long-term health of your portfolio, and not having a well-disciplined method, a process in order to answer that question sets you up for some possible trouble in the future. Because if you really think about it, you can own a company, buy and hold a company, but if you don't have any intention or any kind of instrument or criteria that's going to tell you when to sell, then if the company goes through good times, bad times, you really have no direction in the portfolio. There are plenty of companies, as we know, that used to be the darlings of Wall Street that are now bankrupt, right? And it also helps us determine, by having a sell discipline in place, it actually tells us when not to sell, which might sound kind of foolish to hear, but let me explain a minute. So you own a company, a stock, and it goes up 100% over the next 6 months. Great, you made 100%. Now, if that's happened to you before as an investor, you know that actually, as positive as that is, that creates a lot of pressure for you as an investor. I just made 100% on my holding. Shouldn't I sell it now and lock in that gain to protect myself from the risk of it going down? And vice versa. You buy a company today, and over the next 6 months, it falls by 20%. So you're $10,000 investment in that company is now down to $8,000. Oh, geez, should I sell? Should I wait until it comes back to even before I sell? What should I do? Having a sell discipline, a proper sell discipline, removes that question of what to do. When you have that answer in advance, that allows you to consistently and confidently make decisions, not on the fly, not as a result of price movements, because we know in the short term, price movements move quite a bit differently than what the actual true valuation of the company is, because the stock market in the short term is a very emotional being that's determined by numerous factors, whereas longer term performance of stocks in the market are actually determined by, you guessed it, earnings over time. So whenever we see a red mark, in other words, we pull in information on that day and the estimate is lower, number one, that immediately tells us to look a little bit deeper into the company to see what might be going on, if anything. But that's our trigger mechanism to sell a company from the portfolio. Doesn't mean the company's going bankrupt tomorrow. Doesn't mean there's anything necessarily terrible going on with the company. But what it does mean is that I've got a list, and this list of eligible companies that you're seeing in front of you consists of about, out of the 3,500 to 4,000, about 200 companies that are eligible to buy. So what that means to us as a firm pertaining to our philosophy is there may be not anything terribly wrong with ABC company that lowered the estimate, but what the analyst is intimating to us is that he or she thinks the future is a lot less bright for that company than they thought before. So I've got 199 other potential replacements right away where those analysts are actually revising those estimates upward. That may be much, much better opportunities than the company that's due to be sold right now. And so we keep track of this information, as Matt said, on a daily basis. Our committee and our team we're spending a lot of time, sweat equity, cost, because we understand that what truly drives the value of your portfolio over the long term is the information that you're using and your ability to use that information properly. You can get research, quote unquote research, anywhere. In other words, opinions about a company anywhere. But are they the best? Are they the most quality? Are they being written by the folks that are experts in that particular industry, or are they just merely opinions? So where you buy your research, where you get your research is a critical question that we feel it's critical. We feel it's absolutely critical to your long-term performance. So we keep track of these companies, and all these companies you see in green are ones that have had at least 2 consecutive earnings revisions upward. And we keep track of these, and our clients own these companies, of course, until we see a downward estimate, which is featured here in red along the way. Matt, what else can I say about this particular list in general?
There's different shades of green. I think you did cover that. I think it's important to note that when a red box comes up, meaning when an analyst revises the future downward, we're not reactionary, like, boom, let's go sell it tomorrow or immediately. We have, at the start of the year, our trading days set for about every 6 weeks. Again, that helps us not to be emotional with any of the decisions. It's also what we found the right amount of time to allow for any inconsequential downward and then subsequent revisions back upward to happen by the analyst. Maybe it's like a monetary exchange rate thing. It's something that doesn't really, not substantial to the company. So I think it's important to note that every 6 weeks we know we're trading, and if a company revision, let's say if a company's revision stays downward for the duration of that time until the next trading interval hits, that's when we're selling. Yeah. We're not selling immediately and trying to, gunslinging from the West, day trading. We have a methodical approach to this entire process, to the point where I think, Ben, you'll probably agree, there are days where maybe my kids or something I have going on where I don't know exactly how the market's opening or what's performing. And I don't have this anxiety or stress about what do I need, what do I need to be doing? Where like I'll have clients call me and say, hey, you see what's happening today? Like great news. And I said, well, honestly, I haven't looked yet, but it's not that I don't care. It's that we have such a structured approach and we aren't worried about the day-to-day noise that we don't need to check in daily with what the news is saying is happening because we know how we're going to be managing our and our clients' money.
Mm-hmm. Yeah, that's a great point. It's worth restating. Certainly, is that you don't have to day trade, and you notice neither Matt nor I talked about price of a company as an indicator for buying or selling, because in the short term, these price fluctuations are normal. So there are other strategies out there that certainly we've heard of or followed in newspapers about if a company falls 5% in one day, it needs to be removed from the portfolio. And you go back and look through history, or Matt, I think you mentioned Apple at the beginning of the call, and would you have wanted to own Apple 30 years ago or even 10 years ago? I think the answer is a resounding yes. How many wide fluctuations, how much volatility has Apple had over that time, or any other technology company, or any other company that's done really well for that matter? A lot. Mm-hmm. So focusing on price is something that's talked about a lot, and it is a huge pitfall for the long-term investor. And that word investor is really important to say another word about, because that's investor versus being a trader. A trader, nothing against traders, but a trader focuses on price. I want to buy something for $30 a share, for example, and I'm going to sell it when it hits 35. They don't care necessarily what's going on within the company, other than if that short-term happening within the company, they're expecting to give the price a boost or so on and so forth. We don't care about that. We certainly care fundamentally about what's happening with the company. We care more about owning a company today and still owning that company 3 years from now when it's up 200% or 400%, like some of the companies that we've currently own, or we owned in the past. So that's a really strong point, Matt, in terms of understanding that we're not reactionary. That's why we set that interval. First of all, the interval has worked really well for us and our clients every 6 weeks, but it prevents us from being very reactionary to any kind of short-term market news, and allows us to focus solely on what we've said numerous times today as the driving factor for great long-term opportunities, which is having access and the ability to use great information properly. Absolutely.
Yeah, I look at this and I think it's so simple. Mm-hmm. But when you have this spreadsheet in front of you, when you did, it's not simplistic by any means. It's simple, not simplistic. And that's the term we use, a phrase we use all the time. Yeah. And I know that to be true to my core about most of the difficult but things in life that I use to be successful, like my diet or my exercise or discipline for parents out there, disciplining your children. The concept isn't difficult to understand, simple, but it's certainly not simplistic, because it requires an incredible amount of consistency and attention to a lot of detail. And I think that that's what resonates with people. If we go back, if we're going to wrap this up, because we're right at 3:30, to the beginning of this call, we stated that the biggest problem in our industry is that lack of clarity with what's actually happening with somebody's entire life savings. And when somebody can come to us or even do it themselves, because the strategy is pretty straightforward. If you want to build that list yourself, you can. And if you know, without a shadow of a doubt, you're owning these companies because they've had 2 earnings revisions upward in the 6-month period, you're selling them when they have a revision downward at your next trading interval, and you're going to replace it with a newly minted company that's on that buy list, and you're going to continue that process, then your emotion and also your pressure and your stress and your anxiety of what am I doing with my money goes away. And instead, it leaves that end investor with this feeling of empowerment and excitement about their future, because they finally have a grasp on what the heck's happening with their money. It's happened to me firsthand. My relationship with money has changed. And I'm not kidding when I say it. My entire life has changed as a result. So I'm grateful to this strategy for life changes happening. So I really believe that the education and the understanding of what's happening to your money can unlock a lot of doors or break down a lot of barriers that are holding people back.
Well, well said. Well said. I'll just do a very short dovetail to hopefully close this out. But, we talked last week, based on what you just said, we talked last week about all this opportunity in the future, right? We talked about that a few times last week about really what is the major intention of our strategy. And I would argue perhaps maybe said differently or different words, when somebody invests their money for the long term, what are they effectively trying to do? Well, the world, as we've said numerous times today, is changing. And that's the one guarantee. We're going out in the unknown, like it or not. Tomorrow is unknown. And so how do we capture, granted that you're optimistic, right? This strategy only works for folks that are optimistic about the future. There, I said it, right?
Yep.
If you're the type of person where, the market's crashing tomorrow, and that's always the case, this is not the right strategy for you, right? But for folks that are optimistic about the future, our nation, our world will always have challenges, but can see a lot of the great things that are all happening and will continue to happen in the future. That's really what we're trying to do. We're trying to grasp hold of all this great change that's out there before us. And like you said, Matt, to have a process, that's an idea, right? To have a process that you feel as an investor can put you in front of that change, right? Identifying companies, but also accommodate or acknowledge that, hey, we're going to identify some companies here, but we also know the future's a moving target. So there has to be something systematic, some sort of trigger to keep us going without just blindly going into the future. Mm-hmm. This is a great opportunity. This is a strategy that puts you in front of some great opportunities. But I think I got to agree, Matt, even more so gives you the confidence, empowers you, as you said, to really do things confidently and consistently, rather than divert your attention to different spots every time the market goes up and down. So really well said. I've enjoyed these last 30 minutes with you of going through the list and kind of pulling the curtain back, so to speak, in terms of the data that we prioritize, that we think is vital. And, for folks that want to learn more about what we're talking about today, you've heard us mention this book. Let me see if I can get up there, Dancing with the Analysts by David Malik. Reach out to us, social at Beck Bode, invest at Beck Bode, any of our social media or emails, whatever medium you want to use. You'd like to get a copy of the book, you can give us your information. We can send you a copy of the book if you want to learn more about how we see opportunities and how we attack those opportunities, how we put our investors in a spot to be able to take advantage of those opportunities over time. That's all I got, bro.
It's awesome. Well done. Well said. Thank you for sharing that.
Yep.
That's it.
That
concludes another No Bondcast Live.
Awesome. Thank you, everybody. And we'll look forward to doing the next one very soon.
Absolutely.